Hello everyone, welcome to another financial video from Brockett Financial Services. In today's video, we're speaking upon the Millennial Life Insurance Foundation. And just to jump to it, the reason why we're speaking upon this is because we're trying to help the millennials, secure their foundation and think about the things that they're doing in life that will help them in the future and benefit them most definitely. So life insurance is very important, we all know that. But I just want to give you all a real life, foundation system of what you all can see when you get into life insurance, especially if you have a significant other and y'all married, y'all have kids, and certain things that, involve the both of you all. So this lesson today will be directly focused upon that. So here we go. I'm going to jump to it. In this video, we're going to have a couple. We're going to have the dad. Let's put age 25, right? Then we're gonna have the mom. Let's put age 27. Yeah, she's older than him. Okay, he likes older women. She likes a little younger man. We're just gonna jump to it, right? So a couple things that we're gonna look at when you're getting life insurance, right? We're gonna factor in your income, your debt, and certain things that involve the both of you all. So to begin, let's say that they both have two things, right? I'm just gonna jump to it. A child together because they're married. And let's say they have a house that they own. All right? When you're married, the debt goes on both of you all sides. So if you look on your credit, the house mortgage will be going on the mom's credit and it will also go on the dad's credit. The child is something that you both had together, so we want to make sure that that child is included in this life insurance or what the amount that we'll be getting. So let's jump to it. We're going to say income. We're going to factor in the income. Right. I'm going to write income right here. So let's say dad annual income is $40K, which is $40,000 a year. Mom income is $50K. Yeah, she makes more money than him, all right? Dad gotta hustle a little bit more. All right, now we're gonna jump into a certain thing, and we're just gonna keep this very brief. And the reason why is because we're focusing on millennial life insurance, which is a young couple, right? They're both young. So let's say they are fresh out of school, about 2 years. They have a child, they have a house. We're just gonna stick to the basics, right? Now we're gonna factor in debt. Let's say dad has, make sure I spelled that correctly. Whoa. Let's say the dad has one thing, right? Let's say he has student loans. And that equals 20K of debt, right? I'm putting negative right before that. Let's say he also has a car loan. Let's say that equals, say 10,000, 10K. Let's just say that's all the debt that he has for now. So he has his debt that he currently has, which is 30K. Debt equals negative 30K. 30K in the hole, man. 30K in the hole. Now, let's go to the mother's side, right? Debt equals... Oh, actually, let me write student loans. Student loans. Let's say you got student loans, mom. But let's say you only have 10K. Let's say you only got 10K of student loans. Let's write that right here. 10K, right? That's the only debt you got. So total debt, 10K. Mom. All right, so that's the first thing. This is the debt that they currently have, right? Now, remember when I say they share two things? We're going to include the home. So let's say they have a home loan, mortgage. So let's put house $220,000. Actually, let's keep it at $200,000. $200,000, and this goes on both sides, right? Because guess what? The $200,000 is going to appear on his credit. $2,000 is going to appear on her credit as well. So we put the house equals $200,000. I'm just trying to keep this, together for you all regarding the color wise. So excuse me if I mess up right quick. House, $200,000. Right? So now we know that we have to factor in the house into the life insurance, because guess what? If one thing happens to one parent, we want to make sure that that life insurance policy covers the house as well, so that this parent isn't left paying on the mortgage. We want to make sure it's taken care of, right? So now we're going to factor in another thing, is the child. Two important things. And the reason why we're factoring in the child, right, is because we know if we just say, for example, my mom, she gets a life insurance policy for $210,000, which cover her student loan debt and cover the house. The father will be left with what? Paying for the life expenses for this child till the child reaches 18, when the child gets up on his feet. And we know in reality that a child is never, set by the age of 18. So let's just be more realistic. So let's say the age of 25. So this child will be continuously needing help. The income of what, $40,000, and still trying to pay a mortgage is, probably might, drain the father out. So that's why we're going to add some more insurance into that thing. So what individuals usually do when you get life insurance, you want to go at least, you want to do 5 times your income for that. What would be the living expenses of the child? So now let's add in income, right? Income. Now I'm going to write 50K. 50K right here, so we can all see that. Income, 50K. I'm going to multiply that by times years, 5 years. And now what that total is equals what? 40K. Ooh, that was 40K. Let me get that for you all. 40K times 5 years equals what? 200,000. So we need additional insurance of 200,000 for the dad. Same thing we'll do with the mom. Income. Make sure I do this for you all. 50K. I forgot she made the big bucks, not the dad. No, she made more money than him. Income, we put it times 5 years equals what? 250,000 of insurance. So now we gotta add on. We gotta add for the dad. We're gonna add 200,000, right? Plus the house, plus his total debt. That will be the amount of life insurance that he needs to get. So if we add those things in, let's put total life insurance equals $430,000 for the dad. And once again, all we did was add the income times 5 years, which equals 200,000. We added the price of the house, which is the loan that they currently have for the house, and we add the debt that he currently has in student loans and his car loan. We add those factors in, and he needs 430,000 of life insurance. And for the mom, total life insurance equal, we're going to add in and factor in 250,000 first step, because that covers our income times 5 years. We're then going to factor in the house, which is 200,000, which now brings that to 450,000, and we got to factor in what? Our student loan debt. Make sure it's not carried to the next individual. So in total she needs 460,000 of insurance. So he needs $430,000. She needs $460,000 of insurance. And what we just did was just factor in the debt that they currently have in. We actually did the house as well because they both share that, and then the child living expenses because we want to make sure if something happens to one parent, that income that the next parent receives a sufficient amount of income to take care of the child, the housing, the living expenses. So that's why we factored that in. This video will be posted on YouTube, so you all can view this video. We're actually going to do another video. Our next video will focus more on whole life insurance, and we're just going to break that down so a lot of individuals understand. But another thing that we're going to pinpoint is the infinite banking method, what a lot of individuals benefit off of whole life insurance. But for the foundation, if you're young, if you don't have a spouse, if you're just starting off or whatnot, focus on getting the foundation secured rather than benefiting from life insurance, such as the infinite banking method. And what this will be is term insurance. So I'm gonna write this right here. Put term life. That's what we're focused on, term life. Young person, we're starting off our future. We don't have many funds. We're just trying to get everything secured. The foundation set so we can invest for the future. Term life. So the Millennial Life Insurance Foundation, this is your setup. This is a quick guide for you all. Make sure you get life insurance. It's very important. Secure the foundation, and guess what? Protect the now, secure the future. That's it for today.